Morgan Kelly, welcome to the show, my friend.
Thank you very much, Paul.
Yeah, no, awesome. This has been a subject that Anthony and I have wanted to do for a long time, insolvency in hospitality. Before we jump into get into the weeds, just give me a little bit of background about where you are now and a bit of your career history.
Sure. Well, I'm an insolvency practitioner. I'm a registered liquidator. I started working in insolvency straight out of university. So I started with a Prentice Parbury Barilla, PPB.
Yep.
It was recently merged with PwC. Then I had 10 years with Deloitte. After that, working in insolvency, 5 years in Asia Pacific. And when I returned to Australia, I joined Ferrier Hodgson in Sydney. And with Ferriers, I started working more and more in the hospitality sector, particularly around 2006, 2007, and then became the National Hospitality Specialisation Leader for Ferrier Hodgson. More recently, Ferrier Hodgson's merged with KPMG. So I remain the hospitality specialisation leader for KPMG for insolvency for nationally, and so continue to work in that space. And I've just tended to fall into that kind of market segment.
Yeah, wow.
Some of the matters I've worked on were I was the receiver of the Icon Hospitality Group in New South Wales, Chainer Group. Some of the landmark ones, I suppose, were the Annandale Hotel, which is a career highlight, and the Sandringham, and more recently the Keystone Hospitality Group, which is a fairly significant,
which is now part of the AVC Dixon Group,
which is now part of AVC Dixon Group, correct? Yeah. Exactly. So, and it's not all about liquidation and receivership. We do a lot of work in the advisory space as well with helping distressed venues. We help with lease structuring and negotiations with landlords. We help people who are in situations of distress. We work with a lot of suppliers to the sector, and so we sort of we've got a fairly broad range of skills or a fairly broad range of services we provide to the hospitality sector. But obviously it's grounded in that. In my case, it's grounded in that distressed and insolvency space. Yes.
Yeah, and it feels like you talk about 2006 to 2008, which for anyone that's over 30 was a horrific time. Certainly those that worked in finance and those that worked in property and hospitality in particular. Yeah. It feels a lot like we're heading into that at the moment. And we were chatting before we came on the show today. Yep. We supply 700 plus of the top venues in Sydney and Melbourne, whether that's the hatted restaurants or the gastro pubs or the airlines, but we get to see day in, day out. And there's not one person I've spoken to in the last 6 months that is saying things are easy. And I'm really curious about what you're seeing and what you're feeling, and is there a sense of deja vu insofar as are we going back to what we saw in the late 2006, 2007?
Yeah, it's interesting to draw those parallels. I think 2007 was a horror show, and that continued for a while in the hospitality sector. I think it's important to remember that in 2007 we had a bit of a confluence of factors that all came together at the same time. We had asset prices in the sector, so basically pub yields were incredibly low, and pub assets are really popular
because people were paying high figures. Yeah,
they were paying high figures for venues. And the values that people were paying for venues even then didn't really match the revenues that were being generated. Then we ended up with the smoking bans. Yeah. And we ended up with and then we had all that knock-on effect with the I don't know if you remember, but there was issues around the Department of Health and conducting spot audits of venues. And,
still going on.
Yeah. And then we had people trying things like moving gaming machines outside, and how are we going to keep our gaming revenue going with the smoking ban. And the capital expenditure required for that. So that was sort of one kind of data point that presented at the time. And then we had the more generic, GFC and all of those issues that presented. And asset prices started to come right off. And I remember being at, and there was suddenly an oversupply of hospitality venues. And I remember some of the auctions we used to go to in 2007 when being receivers of a pub. I can't remember exactly which venue it was, but I think it was the first pub that was being taken to market. It might have been in 2008. And at the auction, everyone was standing with their backs against the wall. Every chair in the room was empty. Every person was lining the walls of the of the auction room. And think Damien Cooley was the auctioneer, and he'd been talking the market down in the weeks leading up to it, basically saying, it's pretty dire. But the sector recovered. But I guess what I'm trying to say is there were a few factors that presented then some of those regulatory, which is slightly different today. So then look at what's happening today. We do have a similar situation with respect to asset prices.
People are paying silly money.
Look, people are paying silly money.
Give me some examples of that, Morgan, that you've seen. Like some of and pubs are probably the ones that are easiest to pinpoint. But I saw was it Singleton and the guys that sold the Stain recently that just seemed like a ridiculous price.
Look, I think that there are venues. There are examples of that happening. I think it'd be. I'm reluctant to use the word ridiculous. I'd prefer to say that we're seeing yields at historically low rates, and we're seeing prices definitely. I think everyone is in a consensus view that the market is very toppy, that we're at the peak. Prices can't get any higher. You choose your phrase for that. There are some venues like. I don't know, the Bellevue traded hands not that long ago, or the Centennial that Hemi's bought, what have you, which, given the location and the asset that it was, probably traded for a very fair price.
Yeah.
So I find it hard to generalize across the asset because some of the assets are so different and so bespoke. But what I think does point to it more accurately is the number of off-market transactions that are taking place and the number of pub sales that are occurring without actually going through a sales process or a sales program, and the stories emerging about people vying for a particular venue like the Stain, and then someone else coming out of the woodwork and saying, I would have paid double that. That's sort of the indication of how inflated and how heated the bubbles become. Sorry, bubbles probably not the right word to use as an insolvency practitioner. That kind of thing excites me.
Yeah.
But how toppy the pricing is getting. In terms of regulatory, with the lockout laws, and this is a very Sydney specific comment, but with the lockout laws potentially being relaxed, that may sort of continue that steep curve, or that if the prices are plateaued at a very high level, that may continue for a little bit longer. But what's happening at the same time is all of the input costs and all of the running costs for all these venues are not getting any lower. So the margins are getting squeezed thinner and thinner and thinner. So the kind of organisations that are paying some of these high prices are and this is where it's very similar to 2006. The kind of places that are paying these high prices for venues are ones where you've got scale. So very large chains like AVC, Solotel, Merivale, and Mantle Group have recently moved into New South Wales very successfully with Squires Landing and the Babylon and Duck and Rice in Pitt Street Mall. So these are people, or these are organisations, I should say, that typically with businesses where margins are being squeezed and becoming thinner, you take protection in scale.
Yeah.
I mean, you need to have a scale business to be able to succeed in that kind of environment. Input, your rents are going up, wages are going up, prices of all kinds of product is going up, refrigeration costs and energy costs are going up. All of these things are squeezing margins. So you succeed by having scale. So it's the larger organisations that are
in a good position,
but also able to pay those high prices, and also the investor markets. Now, for a single pub operator or someone who's got or someone who wants to buy a pub for the first time and is paying those over the odds amounts and goes and borrows a lot of money for the bank, they're the ones that'll probably end up in trouble down the track, because if and when those prices come back, or if there's some kind of correction in that sector, then those are the ones that are the ones that haven't got the critical mass or the scale to be able to wear those high prices or to be able to afford those capital costs, are the ones that are probably vulnerable.
Yeah. And is your sense that whether it is those big groups that you mentioned or otherwise, that their capital structure is solid, or do you worry that there is a high degree of leverage in some of those organisations?
I think there's a high degree of leverage in some of those organisations, and the leverage is sometimes not on the balance sheet. So, like vendor finance, for example, is something that often is utilised in this sector. And
how does it typically work? Like, what are they financing off balance sheet?
Broadly, if you buy a venue and you defer the sale consideration, if you buy a venue for $20 million and you pay $5 now and $15 in 18 months, subject to certain conditions. situations like that, that's effectively financing, which is not a bank loan and not something recorded in the balance sheet necessarily as a liability.
Okay, got it.
Some of those situations are, but I think in terms of traditional leverage, the banks have been very awake to the potentiality of a asset price bubble in the hospitality sector for some time and have been very cautious accordingly. So most of the main commercial banks have looked at their portfolios very carefully, been very selective about who they'll lend money to, made sure that the loan to value ratio for a leasehold pub for years has been below 55% for most banks.
Yeah.
In 2006, they would have gone to 80%.
Yeah. Wow.
So that's a change.
And
that's
you
a
sense that it is below that 55 now?
Well, in terms of bank debt, yes. But in terms of potential, who knows what else might be behind the scenes? And there's other things that present in some of these sectors. For example, what the boom's the wrong word for it. The insolvencies that presented in 2006, 2007 were debt driven. You had a situation where you had a lot of hospitality operators that had the Spinnaker right out. They were sailing very close to the wind and they were very highly leveraged and they were making lots of money. But as soon as things went the other way, there was no way to service that level of debt. What I think is presenting more today is a model that's becoming increasingly difficult to make profits and profitability absent gaming in the hospitality sector is very tough because of the margin squeezes.
Yeah.
And again, I come back to that the topic of scale. So you protect yourself from that through scale. Coupled with that, and it's a completely separate topic and probably one we could talk about for hours, is that the trend towards wellness and people just drinking less alcohol, and alcohol sales on the decline globally. I haven't got any data on that for Australia as yet because I think that trend is sort of fairly recent for Australia. But
yeah, I've seen some of it. Like I saw some IBIS reports recently that certainly have showed that other than for some really boutique products like craft beers and some of these real bespoke vodkas and tequilas and gins, etc., that for the vast majority, including wines and mainstream beers, it's in structural decline.
Yeah, massively. And Carlton Zero, which actually I'm quite a big fan of, is that those sales are going through the roof. And organisations like that diving into this alcohol-free beer.
They're all onto it.
They're all onto it. And Heineken's even come out.
Heineken Zero,
well, they're saying
which is line,
And they want to replace Coca-Cola as the drink of choice in venue.
Yeah,
even if it's a McDonald's.
And it's interesting, and we talked about this with Merivale recently, who we're proudly associated with, and those guys are always on the front foot, and they've had these low alcohol beers, not just the Heinekens, which is a line one, but various other ones in their venues now for a year. Even though it's a minuscule component of their overall sales, that they were ahead of the curve, and for the first time in their history, they're talking about. They were always just about experience, but now this whole wellness, wellness of humans, wellness of the planet, etc., seems to be front and center, particularly with that millennial generation.
I think this is a massive structural shift that we've only just seen the edge of, and I think there's something in this reduced alcohol, low alcohol wellness thing that the hospitality industry as a whole is really going to need to embrace. I think that. But if you look at the main components of profitability for a pub or for a hospitality venue, food and beverage becoming marginal because of input costs, and gaming. Now, I think that it's pretty safe to say that there's not likely to be any huge sweeping changes to gaming legislation
other than tighter.
Well, correct, but I think that there have been so many debates and so many incidents, and they had the election in Tasmania and what have you, and I think that's sort of put if you're an operator that depends on gaming revenue, I think you'd feel pretty comfortable that at least for the next 5 to 6 years, there's probably going to be no significant changes in that space. Yeah. Which is good because in some cases that really underpins profitability of your venue and clubs as well. We've not just pubs, but clubs have got some of the same challenges. You've got clubs that have got gaming profits that almost exactly offset the losses on every other service the club offers, which makes them break even.
Which is crazy, and I'd love to ask you if we can park the gaming venues, because without doubt they are profitable because of the gaming most of the time. Some, and again, you use someone like Merivale that buys the Royal in Bondi, that is an old school gaming pub that struggled forever and a day and turns it into this thriving, not just gaming pub, but beautiful restaurant, pumping bar, bottle shop, accommodation upstairs, like a really smart operator, that he seems to be able to make most things work. But if we can park the whole gaming venue to the side, the venues that are surviving on just food and beverage, I completely agree with you that input costs are only going one way. The only lever that I see to make them viable in the future is if we can get consumers to pay for quality. And that's the biggest challenge that we look at as a company and look at insofar as how do we support our venues in doing that, because unless they start buying more for healthier food, healthier drinking alternatives and things, I don't know how they're going to survive.
That's I mean, you've hit the nail on the head, and I think you've probably narrowed a lot of the issues down in those sentences. There's a couple of factors that that play into food and beverage operations, and one of them is, you mentioned the experience and the genius operators, and there are some people out there that can take a struggling pub and underperforming pub and just turn it into a place that you just want to be, and create some kind of environment. And so, and the example of the Keystone Group, although they had some financial problems and a broken balance sheet, the venues themselves were amazing. They were genius. They could take it.
No, they were amazing guys, and they did well. And I want to come back to Keystone because that association with the KKRs and the like, I think we have to talk about, because it presents a whole new level of risk for people that haven't been in that kind of ownership structure before.
Well, taking some of the venues that Keystone Group had, that have small retail spaces that were pretty unloved, and turn them into the winery. That kind of that's the art of running a food and beverage venue, and some people have got it and some people don't.
But they were amazing at that. But this is my view on Keystone, is that they then went and bought the Jamie Oliver franchise that fundamentally didn't fit in the Australian culture.
We might come back to that, because there are a number of factors involved with that I think were probably problematic. But what I'm trying to articulate is that you've got operators that can create a really great customer experience in a really great venue. And I think this all started with the small bar licenses when they were brought in. And suddenly there was an arms race in terms of venue. You've got a new venue that's opened up that's serving, drinks in jam jars, and everyone sits on milk crates or what have you. Oh, wow, this is new and exciting. This is cool. So everyone starts going there. Then the chap that's operating the Brooklyn or the Morrison or whatever goes, well, I better lift my game.
Yeah.
And that was happening all over Sydney. And even in the Oaks Hotel in Neutral Bay had suddenly all these small bars opened up in the strip next to it, which was fantastic. It made the venue, the precinct became really cool and really exciting. But it was taking a lot of business away from the Oaks, which then renovated and changed its offering quite dramatically. And gradually those small bars shut down and disappeared. But what did we end up with? A much better offering from the Oaks, which is fantastic. So the consumer's a winner.
Yeah.
These kind of in-venue experiences and these kind of venue offerings, I think, are really, that's actually the ticket to play. And operators that can really do that have the opportunity to then make money and thrive and survive. The second part of it, though, is, and I think this is what you were touching on before, provenance is key. So this is the other side of the story with the wellness and the health and the well-being. Everyone wants to know, where did this steak come from? Where was this beer made? Where did the water come from that they used to make the beer? And the story behind the food and the story behind the where everything's come from is just as important as that customer. It's part of that customer experience. And I think operators that get that right are really ahead of the curve.
I agree with you, and I think there is definitely a lot of lip service around that. I think particularly in a time like now where it's just fundamentally hard, that the offering of I can get this a couple of dollars cheaper per kilo vis-a-vis this is a really great provenance story. I'm still seeing that venues, even the big guys, are being drawn into we just need to make our margin, as opposed to going, you know what, if we're in this for the long game and we truly believe that this whole wellness, premiumization, personalization, and all these other themes that are real out there are the long-term viability of our venues, then we need to perhaps earn a little bit less now, but win the trust of our consumers, because I'm not seeing it in practice other than a very, very select few venues.
You just used a really good word, which is trust. And that's a really important concept in this whole discussion, because that wellness discussion and the provenance discussion has two components to it, like almost like a carrot and stick, or a good story and a bad story. The good story is that our food is sustainably produced, and it's better for the environment. We've got a low carbon footprint. We're conscious of our climate impact and our responsibilities to the environment and what have you, and also ethically managing the animals if that's the situation, and being and having that kind of and those are the positive stories. Then you have the negative stories. It's not full of Roundup. It hasn't been sprayed with chemicals. You're not going to get cancer because you ate this steak and you save $2 from eating something cheaper, and as a result, it's not good for you.
Which seems like such a logical conversation. And you know, we supply a couple of the major banks here in Australia, and I certainly won't mention which one this was, but we had this conversation the other day, you know, and they've got catering services in all their venues across Sydney, and this thing around we need cheaper chicken, you know, we need it to be $2 cheaper. And we go, you've got some of the best paid, most conscious, intelligent client base of any organisation, and it's probably funded by the bank anyway to a degree, and yet you're trying to find a product that's $2 cheaper as opposed to sticking with a product that you know is free range, that you know isn't washed in bleach, and all these other things that are critically important. But you have certain, and there's a bunch of them that don't fit into this, so I'm certainly not branding everyone this way, but certain chefs that the only thing they know is COGS and gross margin, and that they can't take those blinkers off and see that the world is moving. And then unless you are seen as a trusted supplier of food, then ultimately you're going to go out of existence anyway.
That's an absolute race to the bottom. And I think the Greta Thunberg, that activist in the United Nations, would probably say that kind of thinking is part of the problem in terms of why
it is the problem
in such a mess at the moment.
It is the fundamental problem, and the race to the bottom we talk about all day, every day.
That we need chicken at $2 cheaper. That's just, I mean, quite frankly, that's just stupid. And I'd much rather. Sorry, can we strike that from the?
No, we can bold and underline it. It is fundamentally it's dumb business.
That's just dumb. But the thing is, you know, consumers see through that. They really do, and they don't. So I've got a couple of things swirling around my mind at the moment. But I think you'd much rather see that chef that you talked about that only understands costs of sales. I mean, a kitchen is a logistics exercise. There's probably going to tell a bit of a long story here, but there's a point to this.
It's all good.
My father-in-law works in aviation logistics, so it's a very complicated, you know, lots of scientists, lots of physicists, people in white coats, and you know, all kinds of algorithms and simultaneous equations and stuff. It's way above my pay grade. But he once said to me, the concept of having a group of 6 people all order different things in different combinations, which then goes to a kitchen, and it all arrives at the same time at the table as ordered, and all at once. He said that's something that an aviation logistics organization would never be able to deliver. But that's logistics taken to another level, which is the brain of the chef. Yeah, that's the work.
Yeah,
in the
they're
kitchen.
incredible like that.
There are a lot of efficiencies and a lot of economies of scale, a lot of ways to either blow your cost of sales out of the water or to keep your venue profitable by how you manage your kitchen and how you manage the staff, which is not rocket science, and I know everybody in this industry knows that intimately. But you'd much rather see somebody concentrating on that rather than trying to save $2 on a chicken breast order, and focusing on the logistics and the delivery rather than the input cost.
But I think that's that, as much as I think it's a nice thing to say that they know it intimately, I don't think they do know it intimately. I think there are certain chefs that are amazing at it, and they do understand that running a kitchen is a logistics exercise, and the true savings are in doing that hyper efficiently. But for a big chunk of chefs, the only thing they know is I buy it at this price and I sell it at that price, and it's the only lever I've got.
Yeah, which is not, that's not the case, and it's the whole machine. It's not just the kitchen, it's the wait staff, it's the table management, it's everything working together to try and keep it as efficiently as possible. But it has to be seen as a logistics program, and it has to be seen as a logistics exercise. And actually, look, there's lots of I'm probably jumping all over the place here, but there's lots of software around that can help with managing some of these things, with rostering and scheduling, what have you, and ways for operators to try and improve that. But one of the reasons why this industry's got such a high turnover of restaurants, for example, and the average life of a restaurant is actually distressingly short for a
what
new
is
venue.
It on average for Australia?
Oh, I couldn't tell you. Probably between 12 and 18 months, I'd imagine, would be for a new venue. And often it's the case that a new operator or a new entrant learns these lessons the hard way, and then at the end of it, moves on and is quite burned by the experience.
Yeah, completely burned out.
It's a challenge.
Yep. It's a perfect segue, Morgan, into I was going to ask you, because the one thing I do love about chefs more than anything is their passion for food, their passion for experience, and it's a beautiful thing. But the decision for a bright young chef or a bright not so young chef to go from the structure of an organization, whether that's one venue or a big group of venues, and say I'm going to do my own thing, when they've had no business experience outside of probably the buying of the produce for someone else. What's your advice to those people?
Don't go it alone would be my advice. There are a lot of moving parts to any hospitality business is a business, and there's lots of different components and different things that need to be managed and need to be administered. And I think it's best to actually not try and take. You're already taking a risk when you try and do something like this. You might as well mitigate that risk by doing it with someone or under someone, or whether it's in partnership or whether it's an employee with somebody else that gives you an opportunity to have that apprenticeship and see how those operations are actually run. So don't jump into the CEO seat straight away. Try and see how all the back office things work, how the ordering works, how the marketing works, how the accounting and finance function works, and all the different logistical requirements there are for BASs and ATO reporting and little things like that, and how you arrange finance and how much finance should you have. So having good advisors as well is very useful. And and if you're interviewing or screening people to actually take that tandem parachute jump with, have a look at their CV and do some due diligence and do some research. Don't necessarily take someone at face value. If you're looking at an advisor, ask them about their experience in the sector and ask them for some names of people that they might be able to give them references or give you some feedback about what kind of service level they've offered. And if it's an operator in the sector, Google them, ask around about them, see what you can find out about that particular person. There are some really good people out there in this sector who are interested in funding it with equity or funding it with debt, or providing advisory services to the sector. And finding those people will make the journey a lot easier and maximise your chances of success.
Yeah. For those people that have a venue and have bitten off more than they can chew, don't have the experience, they're struggling, we're sailing into an economic headwind, and they're just battling to keep their head above water. What's your advice to those venues? You know, even if there's more than one venue, but get out or just batten down the hatches.
Well, look, I don't think there's a
one answer for
I
anything.
think there's one answer for everyone. I mean, one thing that would be, the first and most obvious answer I would say is if there's a venue that's in difficulty in terms of trading, or just battling to keep head above the water, potentially think about what sale options there might be. So potentially talk to a sales agent or something like that to see whether that is actually an option. And the reason I say that is that given the shortage of hospitality venues in the marketplace, and the fact that there are some larger chains that are acquisitive, and looking to plug new venues into an existing network, there may be opportunities there. That's one option, but alternatively, look for an equity participant. There's a lot of investor money in the market. There's a great deal of investor money in the market at the moment that's looking for a home.
Coming from where? High net worths or funds or?
Coming from, at the moment, given the way the interest rate environment's going, putting money in the bank's not really a very viable option for God knows what inflation is at the moment, but it's probably more than you can get from the bank if you get a deposit.
Yeah, for sure.
It's coming from pension funds. It's superannuation money. It's high net worth individuals.
Yeah.
It's family offices, and basically equity money that's looking for a home. Under the right circumstances and, in the right, negotiated the right way, that can, equity's more patient than debt. And possibly sharing profits with someone through dividends rather than paying interest, might be a solution. With some sort of balance sheet restructure or move. And also, of course, there's the, is there anything you can do with the business? Is there anything that can be changed in the business model itself? Is there anything that can be changed in the actual offering? One of the things that I've often experienced is that with hospitality operators that are finding themselves in some form of distress, whether it's operational or financial, you're so busy surviving and so busy doing the same thing day in, day out. There's no time to take a deep breath and take a step back and say, am I doing something wrong?
Yeah.
Is there something here am I missing something? Is there something here I should change? Should I talk to someone? It's hard to do that when you're working 12 to hours a day and
12 plus,
12 plus, and trying to keep.
I always see it. It's horrible, and then that whole vicious cycle of how do I get out of this, and the stress and the anxiety and the whole mental health thing is it's horrible to watch, and you do see it regularly. Are there some common characteristics that you see with, and let's stick with smaller venues, because I think the bigger guys are just, they, even if they're underperforming, they're okay and they're well capitalized. But the smaller venues that you typically take to insolvency or out of insolvency, what are the common characteristics you see insofar as why they failed?
Probably often there's cost structures that don't match the actual venue or the venue's capabilities. Sometimes it's the actual offering itself. The offering might be obsolete, or it might be just simply too bespoke, or it might be too narrow. Conversely, sometimes the offerings, the venue doesn't know what it is.
Too broad.
It's too broad, and the venue doesn't actually have a personality or a definition. There can be a variety of issues because hospitality is so. It's often so driven by consumer whims and by
fickle
market
consumer
demand.
whims.
Fickle consumer whims. So I do think that the consistent theme that we often see is that, and to be really blunt, like the air conditioning's not working, the venue's really tired, there's been no reinvestment in the business. Well, why is that? Well, revenues have been coming down for a number of years. So
that's a vicious cycle.
They haven't had enough money to reinvest.
No time, no money.
No time, no money. They can't reinvest in the venue. The venue's getting tired. Oh, look, we haven't got enough money we're not paying the POIG because we've got to go on a repayment plan with the tax office. You've got all these working capital constraints that come up, and because that sometimes happens over a period of time, it's difficult to point to why is that happening? And if you've got like a I don't know, a steak restaurant that's in a trendy area that's full of vegans, then maybe you need to change your menu.
Yeah.
Not that. Sorry, I think I've just used the V word. I'm sorry.
It is blasphemy. You know.
Am I going to make it out of the building alive?
Listen, we love the vegans. They all come back eventually. You know, it's like dry July, man. It's not dry 2020. It's,
correct.
You know, they ultimately get bored or sick. So. And they don't understand the problem. But mate, I'm not asking you to opine on the vegans versus the carnivores. But yeah, there is some commonality, no doubt. Do you think the bigger groups are just going to continue to dominate?
I think it's. I think we're seeing some really interesting shifts. Some really interesting evolution in this sector. The bigger groups have got the advantage of scale, and the larger operators are clever in the way that they do that. We found with a situation like Keystone Group, having a national footprint was in some ways a real headache. So you've got logistical issues. In a country like Australia, you've got distance between, like from Sydney to Perth. There's very little synergy in supply chain. You know, you don't really have any benefit in having that. So you might as well have a restaurant in Indonesia. Whereas if you're in England and you've got 15 restaurants, then you can have one egg supply for all of them, for example, or something like that. So I think that most of the operators that I think of are executing really well on scale are doing it in a clever way of sticking to markets they know and understand. That's a really
such broad brush point.
That's a really broad brush comment.
I think it's such an accurate comment. And again, you look at a group like Merivale that just not only do they know the city that they want to operate in, they know the areas that they want to operate in, and they've never deviated from that. And it's a wonderful success. And on the flip side, you know, other really well operated groups like a Solitel that do an incredible job, but went up and we did this too. So it's no criticism of Solitel, you know, try to open in the Brisbane market as an example, thinking that Aria is successful in Sydney, so it'll be successful in Brisbane, and it didn't work. And you just lose focus on your core markets. I tend to agree with you that it's really difficult, particularly nationally. I think you can do Sydney and Melbourne because they're very similar markets. Hospitality-wise, they're very similar consumers. But I fundamentally believe that states like Queensland and Brisbane are very different to Sydney and Melbourne.
You stick to what you know. I think that in terms of driving returns, I think it's going to be the groups like Solitel and Merivale who are going to be able to, and they're already doing this, like leveraging their scale to drive profitability in a very marginal business. But also, and I'm going to use the magical buzzword that everyone's using, but using data. If you've got one venue or two venues, you don't really get a lot of data that's really useful from your own operation. But for these larger scale operations, they're actually able to utilize customer data themselves and use that to play off their different venues within their own group, sort of to use those to squeeze more out of their customer base. By the way, that's not to say that if you're a single venue operator, you should ignore data. Quite the opposite. You just got to get it from a different place. So there's all kinds of publicly available data, social media data. And it's really important to while I'm on this little bandwagon, it's really important for everybody to, if you're in the hospitality sector and you don't understand the benefits you can get from data analytics and from data itself, you really need to get a handle on that. And it's one piece of advice I would give anybody that works in this sector. Don't ignore it, engage with it, understand it, find out about it, and use it. Because it's a really, really powerful tool.
Yeah, and again, I couldn't agree more with you on that. I think the biggest challenge, particularly for these one venue operators, is that they're so time poor and they don't have that capability. They're passionate chefs typically that opened a venue and, you know, they wouldn't even know where to start to look for data, you know, with no disrespect, let alone how to use that data to turn their venue around. And it's, again, that vicious cycle of where do I go for help? I don't have a lot of money to go to a KPMG and get some advice. There's consultants that seem to float around the hospitality industry that are all burnout chefs that, provide the same kind of advice that the chefs got themselves. And I see that, and I think it's a flaw in the industry, that the real valuable advice that's probably more expensive than the burnout chef giving advice just isn't sought out regularly enough.
Well, I think the Australian Hotelier conferences and forums that the Australian Hotelier is starting to run are actually a good start in terms of, because you almost need an academy or some kind of repository of information for people to share information. And
it doesn't exist.
Well, hospitality operators are notoriously tight with money and they're notoriously secretive about
that's so true.
So I think that sort of thing's a good place to start having conversations. And I know that they're focusing on things like data and starting to try and have, like, at their conferences, educational. This is, by the way, there wasn't meant to be a plug for the Australian Hotelier conference, but I think it's definitely worth going to.
Yeah.
And that kind of thing's really important. But I've gone off track a bit with that first comment. I think those larger groups are here to stay, and I think that in an increasingly marginal sort of sector, those are the kind of the operators that are going to be that are going to be sort of future proofed in that space, and that's not a bad thing. That's a good thing, and they'll be able to afford to be able to sort of lead the way with that in-venue experience and that consumer experience, and kind of lead these trends about provenance and food and where it comes from, and the story and all that kind of wellness and all that kind of stuff, which actually does pave the way to a larger degree for the smaller operators. So it's a good thing. It's a good thing.
Yep. I want to come back to, because we're seeing some of it. We talked about Keystone before that got into bed with KKR, and I think it was the beginning of the end for them. They somehow set themselves up for failure, in my eyes. We're seeing it now with the Rockpool Group and Quadrant. We've seen the ABC, of course, is owned by KKR. Do you see it largely as a positive for hospitality operators to have professional investors involved? But the other part of the question is very much, what should they be wary of when they start to partner with some of these professional investors?
Oh, definitely. I think that there's definitely a positive, and it's a huge opportunity. And going into business with KKR wasn't the demise of Keystone. It was that's a timing issue. They're going to borrow money from somebody.
A ruthless lender, though.
Okay, probably. I don't want to go into too much detail about this, but KKR were very supportive of Keystone Group, and they were they certainly didn't. They provided a lot of support for Keystone in the lead up. There were a lot of issues presenting with Keystone Group at the time I was appointed receiver. The business had become chronically undercapitalized. There were a large number of issues that were creating working capital problems for them, which was largely driven by their growth plans, and KKR was completely divorced from any of this in terms of the strategy. So basically, what I think happened with Keystone was you had an incredibly successful business and a very, very successful operation, and the guys that ran Keystone had that skill, they had that they're not still around. They have that ability to take a venue and make it amazing and make it a place you really want to be. For my part, I thought that I think it was the growth or the rapid growth of new venues for Keystone
across Australia, New Zealand.
Across Australia, New Zealand. Yeah. So you had the Jamie Oliver franchise agreement involved, opening new venues at a very rapid rate. So they were opening a venue, I think, every 3 months. And these venues, well, as you know, there's a ramp up phase. You don't make money straight away. First of all, you're paying about in excess of $1 million a pop to open a new venue. Minimum, because all the marble's got to come from Italy, and all the toilets have got to come from Bath in England, and gold taps, and it's all going to be high spec. The Jamie Oliver offering was all organic food and what have you, but at a very moderate price point, and which is good and understandable, and that model can work in a different environment with the labour costs in Australia, and the fact that back to those points I was making before about the supply chain, and the fact you don't really get economies of scale when you've got a restaurant in Adelaide, Perth, and Sydney, and Brisbane, and Parramatta, and Canberra. It's pretty difficult to get economies of scale there, where all the suppliers have to be locally produced organic food from local farmers, and it all needs to be fresh. So you need to have a bespoke supply chain for each venue. It's pretty hard to generate margins from that. So, and when you're opening new venues over and over again, and the business is expanding, sometimes your management information system isn't able to really give you real time data to tell you exactly how you're performing. That's a perfect storm.
Yeah,
and then when you've got the money going out the door to actually fund the opening and fund the cost, just the simple stuff, the builders, the fit out, the marketing expense, and the marketing campaigns for each opening, and you're doing that every 3 months. That takes a lot of money out of the business that you need to be spending on bonuses for staff, on maintaining air conditioning, on paying for refreshing the fit out in particular venues and things like that. So that's really where it sort of came a little bit unstuck.
Do you think part of it was also a distraction from the Golden Goose? The thing that they were really good at, the wineries and bungalow acts and those things that really were cash cows. And I so respect people that are ambitious and growth orientated, but from afar, it did look like they forgot about the golden child.
I think I don't think they'd forgotten about those venues. I think it was more a matter of that, like every day, going, how come we haven't got enough money to put back in? How come we haven't got enough cash flow to spend on these? And the management information system wasn't delivering them the answers they needed to have. So they were in a bit of a vacuum. So operationally, everything was, you had everything there that they needed to have. What they were struggling with a bit was where's all the money going? And in hindsight, it's always 2020, and it's now easy to see where it was probably going. Yeah,
and it's really good to see all of those boys recovered and doing their own thing again now too, which is great, because they were passionate, intelligent, good operators, and it was heartbreaking to see them fall so hard.
Absolutely, and individually brilliant operators.
Yeah, no, I completely agree. Are there people you see in the industry, the smaller groups that are growing? You look at Marty Short that came out of Keystone, that went on his way, that has the Glenmore and the Aussie and Misfits, etc., and just sails under the radar. And do you think those operators are smart? They seem to just sniff around for unassuming, low-profile pubs, whether it's here in Sydney or up the coast. Do you see that as a good business strategy?
Oh, absolutely. And there are a lot of very, very clever operators. There are a lot of very clever operators in this space, and definitely. And that's Marty Short's a good example. I think as well, just on that is you've just sparked another thought in my mind though about the. It used to be regional and rural pubs used to be a real white elephant, and sort of they were all failing left, right, and centre, what have you. There seems to be some of the smarter operators are sort of turning their eyes back to some of those locations like Bathurst or Orange or regional Australia, where there's a lot of growth, and a lot of the under the radar operators are starting to see some value in some of those venues as well. And that's partly driven by the lack of stock in Sydney CBD, but also partly driven by the fact that, you can't find a builder in Orange for love or money at the moment because it's just booming.
Yeah, wow.
So, it's an interesting time.
Yep. Margin-wise, what should pubs, let's use pubs and restaurants, what should they be targeting as a minimum? Net.
You mean sort of net. I think if you're below like between 5 and 9%, then you should be looking at least a 25 to 30% gross margin. After that, it depends on how. If you're not doing that, you're going to really struggle to meet your if it's particularly leasehold, to meet your rent and your labour costs. After that, when you get down to net profit, it's more of a Depends on who. It depends on how you report and where you put your numbers. But
assuming that it's all bona fide reporting, because I looked at the stats and it's 4.5% on average for restaurants in Australia across the 23,000 odd restaurants. That just seems like there's no margin for error.
No, there isn't. The gross margin for a restaurant is in some ways highly variable. I think that if you're up around the 8, 9, 10%, you're comfortable. And this is at net profit level. 4.5%, that does tell the story about how marginal these businesses really are, and there is no room for error.
Yeah, and the return on capital is outrageously
forget about
low.
return on capital. It's a that's an aspirational goal.
Yeah, and the really good operators. If you look at the Mr. Wong's and some of these amazing restaurants that we have around, the Arias, etc. Like how high? Obviously not we're talking specifics here, but the really well-run restaurants, are they getting 20%?
30% sometimes
30%
at gross
some of
margin
them?
level because the really
No,
good control.
net. Let's talk net.
Oh, net. Well, look, I couldn't tell you what Merivale's or what those. I simply don't know. But they'd certainly be in excess of 10%.
Yeah, which is amazing. What's scaring you over the next 12 months in hospitality? I don't mean as a KPMG because probably going to be good for your business, but from an operator's perspective, what should they just be fundamentally focused on to get through this cycle?
I think that debt. I think is probably debt is an issue, and debt's never been cheaper. Interest rates probably aren't going anywhere for a while. So that's one sort of data point there. But you can still have too much debt, and if your margins or your profitability are eroding, that can become a real headache. So managing those debt levels is really mission critical. I think if you're a smaller operator, you have to think very carefully about your strategy and the implementation and integration plan for buying or acquiring new venues right now, and having a really clear understanding of exactly how that's going to execute. Unless you've got a very large balance sheet, it's definitely not the time to make an impulse buy. But at the end of the day, I think asset pricing and the prices of these venues and where yields are at the moment is probably really going to be. I think that's probably the elephant in the room.
Yeah.
And there's a variety of opinions on that.
That some think there's still blue sky.
Well, how can there not be if interest rates are this low? Do you know what I mean?
But it seems perverse. That theory of asset growth because debt is cheap
it is perverse.
Irrational,
it's wrong because
exuberance.
It should be tied. It should be tied to revenue. It should be linked to yield from simply from venue performance. But it's not, and that disconnect is confusing.
Yeah, where do you think these bigger assets, the AVC Group, the Rockpool groups, and things, do you think they've got a natural exit in Australia, or is it going to be a global buyer?
I think that there's naturally IPO is probably one of the first places that you think, or one of the first places that you go to.
And you think the public markets? Well, I think AVC, it works. It's their pubs, their gambling venues. They have recurring revenue, and I suppose to a lesser degree, Rockpool has increasingly, is underpinned by the Bavarian and the more predictable stuff. But it seems like a less predictable income stream, and I just wonder whether the public markets will like it and value it as much as an AVC. Well,
historically, they haven't worked out brilliantly. But that is the hospitality chain IPOs. But as you said, this is a slightly different animal, and it's a different environment and a different beast. So I think we'll need to see where how the market responds to that potential transaction with AVC, and with that listing. they seem to be unstoppable. And remain acquisitive. We'll just have to time will tell. The market will tell us.
I think that one will get away quite easily. The one I really hope is a smashing success is the Rockpool one, because I think if it is, and
got some great venues.
They've got some amazing
venues.
But I think that if it is, it will just open the way for other people to get that kind of support, to allow other operators that have toiled their whole life to get professional investors to come in and, to get some of their sweat equity back, and to really, I suppose, achieve their growth plans that they probably couldn't do on their own. And my big fear is that if it's unsuccessful, which I know Enquadrant reasonably well, I find it hard to believe that it won't be, but I worry that if it is, that it will really shut the gates for a little bit for other people.
I don't think so.
No?
But I think those. I think that that equity and that private equity and the desire for private equity to join and to invest in this space is already there, and is very, very strongly there. And I think there are a lot of opportunities for successful operators that are ready to make the transition or wish to make that transition right now, and they're presenting right now. It's just got to be careful and make sure it's done in the right way.
Yeah, interesting. We could talk about this all day, my friend.
Yeah, we could.
Morgan, thanks for coming on, mate. I really appreciate it. You got things to do.
Fantastic.
I got things to do.
No, thanks very much, Paul. It was a pleasure.
My
Thank you
pleasure,
very much.
buddy.
Good on you. Thank you.